I just wanted to revisit the topic of a potential crash in Chinese property, because you mentioned that earlier in the year. What are your thoughts on the sector now?
Well, I think that there are some symptoms of a bubble building in China. We have this rapid increase in foreign exchange reserves. We have very strong credit growth. We have rapidly rising property prices. And a bubble is obviously building. Now, it's always very difficult to tell at what particular time or which day the bubble will burst. Say, I turned bearish about Japan in 1988. I had to wait 2 years until the Nikkei collapsed. And I turned negative about US tech stocks in 1998. And it took another 2 years until the tech bubble burst. So I'm not saying that the Chinese property market bubble is bursting tomorrow. However, I'd just like to observe the following. First of all, the Chinese stock market is still far below its peak in 2007. Secondly, the stock market in China is lower than in August 2009 and is lower, as is the Hang Seng Index, than in November 2009. In other words, we have essentially a boom in properties, but it's not reflected in the stock market. And I think maybe the stock market is giving us a signal that not all is right in China. And all I'm maintaining is that if the bubble burst in China, you don't want to be, say, in Australian stocks, in the Australian dollar, in commodities, in industrial commodities like copper and nickel and aluminum, because the demand for commodities in a scenario of a Chinese bubble bursting is going to go down very substantially. So there's a risk. Now, it may not happen right away, it may only happen next year, but this is an investor should keep this in mind, that when the bubble bursts in China, and for sure, if it doesn't burst now, it will burst, say, in 6 months. If it doesn't burst in 6 months, it will burst in 12 months or in 18 months. The longer it doesn't happen, the worse it will be.
I see. But the Chinese government has taken steps recently to cool their market, putting some measures to clamp down on property speculation and such.
Well, that, you know, either you believe that the government can steer an economy like a car, you put the brakes on and then you put the foot on the accelerator and so forth, and you can perfectly steer it. That is not my view. I think that governments eventually create a misallocation of capital, and measures they undertake, either through monetary policies or fiscal policies or regulations, always lead to some unintended consequences.
So what must they do at this point?
Well, I don't know. I'm not running China, but I would say that interest rates, like in the US, are artificially low. I think that interest rates, the lending rate in China should be at least twice as high as it is now, and I think deposit rates should be substantially higher. I also happen to think that the zero interest rate policy in the US is creating other bubbles, the way we had bubble building after 2001, when interest rates were kept artificially low. At that time it was a housing bubble. This time it may be a bubble in stocks or in commodities or whatever it is, or in emerging economies.
I see. You spoke about some unintended consequences that might lead to unintended consequences given the steps that the Chinese government is taking. What are these unintended consequences?
Well, as I said, basically the Chinese government would like to have a strong economy, strong exports, strong domestic consumption, strong capital formation. What they don't want is excessive speculation in properties and excessive credit growth that finances this excessive property bubble. So that is an unintended consequence. Now, to target just properties and not damage the other sectors of the economy will be difficult, because the property market has now become essentially so big. It's like the US. In the US in 2006, the property market became too important for the economy, so when it no longer went up, it hurt the rest of the economy.
Given what you said, I mean, the Chinese government put in all these measures. Are you saying that there's very little impact of the measures? What sort of impact will...
Well, I mean, what can happen is that when they tighten and bring about, say, really slower credit growth and restrictions on property purchase, that actually the market may start to ease quite considerably. And then to arrest the decline may be not so easy.
I see what you mean. And speaking about this, property prices actually rose 11.7% in March.
Yes.
A record for China.
So yes, if you annualize that, then property prices go up by more than 120% annualized. So, you know, you have to be quite optimistic to think that for the next 5 years, property prices will go up by 100% every year. And I mean, I'm not saying it's impossible. If you print money, everything is possible, then everything goes up. But eventually there'll be a massive crash.
So have we peaked out now? Or?
Well, I have no idea whether we peaked out now. And China is a huge country like the United States. You can have a market peaking out today, and another market may peak out in 3 months, and another market may peak out in 6 months' time. It's not homogeneous. It's like a stock market. Not every stock will peak out the same day. Some stocks peak out today, and some stocks maybe only 18 months later.
So what's the danger signal? What are the 3 signs you look out for?
Well, excessive credit growth. In January, bank loans increased by almost 50% of GDP. That is a danger signal. 11% increase in property prices in 1 month alone is a danger signal. And we have a world where interest rates will likely go up regardless whether the government increases the interest rates. If they don't, then the marketplace will increase interest rates. So we have all the danger signals in place. But it doesn't mean, as I told you, that the whole thing collapses tomorrow.
Just to rephrase, I guess, what is the danger signal you look out for before you know this is the peak? Yes.
Well, you never know for sure when a peak happens. I mean, I didn't know that March 19th, 2000, that day was the peak of the Nasdaq. It could have been 3 months earlier or 3 months later, period. I'm not a prophet. I'm not someone who could push a button and say from here on the market will go down, and press a button from here on the market will go up. Maybe you can do that at Bloomberg, but I can't, sorry.
But you've been very accurate in the past. Okay,
yes, so I'm just telling you, if I were an investor, I would be careful today about buying industrial commodities, and I would be careful about buying Australian stocks, because the Australian market has several factors that potentially could be very negative. A slowdown in China or a crash in China. Both would have an impact on the demand for industrial commodities. Secondly, we're talking in Australia also about the housing bubble. It's not just China. We also have a housing bubble in Canada. It's just delayed vis-à-vis the United States. And we have a currency that was very strong. So basically, the Australian and Canadian economy, Canada to a lesser extent, are very tied to the business cycle in China. And I think from here on, the Chinese economy will slow down regardless. Whether we will crash this year or later, that I don't know for sure. And even in the context of a millennium year, it doesn't matter. The US crashed so many times between 1800 and 2000, and the economy continued to grow. I'm just saying, near term, if there is a crash in China, if there is a slowdown, then we will have an indigestion in the investment markets like we had in 2008.
Sounds painful.
But you, if I were you, you're young and optimistic, keep on buying Chinese shares. Yes.
My risk profile is low at this point, right? How about the yuan appreciation? How will this play out?
It would, in my opinion, be good for China to have a stronger currency, but I don't think it will be good for the property market or for the share market.
Why?
Well, because it makes China temporary, I'm not saying long term, but temporary less competitive.
That's right. And how about the yuan appreciation? When do you see that happening?
Well, I think they probably have a gradual appreciation. You better ask the Chinese Central Committee when they want to move on the appreciation. I don't know for sure. But tendency-wise, for the next 10 years, I think the Chinese currency will appreciate against the US dollar. Actually, I think just about anything will go up against the US dollar.
How much would make sense in terms of appreciation this year for the yuan?
Well, I mean, my view is that the yuan should be twice the current level. In other words, it should appreciate by at least 100% against the US dollar. That will not happen this year, but say over the next 10 years could happen. It doesn't mean that the yuan is a strong currency, it's just less bad than the US dollar.
I see, but what sort of appreciation, can you quantify that this year?
Well, I mean, this year it could go up, say 5–10%, could be. Maybe it won't. Depends on a lot of different factors. As I said, if the Chinese economy crashes, then it's not likely that they will have an appreciation of the yuan.
Now, what's going to push you towards that 10%?
Sorry, I have to go now.
Oh, can I just ask you a question on how this spills over to Hong Kong real estate then?
Well, the Hong Kong real estate market is, of course, very tied into the Chinese property market, as are casino companies in Macau. The whole Asian region is very dependent on China, and if you have a slowdown in the Chinese economy, it will have an impact on asset markets in Asia and in the resource-producing countries of the world, as far away as Brazil. And on Hong Kong property prices, if you have a crash in Chinese property prices, the high-end sector in Hong Kong will get hit very hard, very hard. So again, I would be a little bit careful about buying a luxury condo right now, but you may do that for yourself.
How about if I put it this way, the Chinese government clamping down on property in the mainland, will that help the Hong Kong property sector?
Temporary, maybe, but I think the world is not quite as a clampdown in China will boost the demand in Hong Kong. I rather think that the clampdown in China will leave a lot of losses in China, so there will be less money to invest in Hong Kong.